Hello everyone, this is Jose Blasco. How are you? We're about to get started in 30 plus seconds. Sound check, please. If you could type on the chat box hello, that means you heard me. That means sound is good. And it's always a nice way to get started. Let's begin in 20 seconds. Please, everybody writes hello. Thank you so much. Good morning, Mark. How are you? Good to see you. Very good. 7 seconds to go. Almost time to get started here. Here we go. Time to get started. Top of the hour. Welcome, everybody. Today is November 17, 2022. My name is Jose Blasco. This is Options Trading Live. We're going to be spending an hour looking at the markets, more specifically looking at options markets, options opportunities, and we're going to be discussing that in depth. Before we get started, I would like to highlight our financial disclaimer. Please read it carefully. It is important information. It is being highlighted on the upper left side of the screen, and I am counting on you all to read it completely as always, okay? So please do that. How are you, Jeff? It's good to see you. Very nice. I've been missing you guys. I've been a few days away. Not 100% me. You may still feel a little bit of my voice is a bit weird. My throat was really not well. So sorry about that. You may see me take a few sips of water today, more than normal, because of that reason. But again, very happy to be joining you today to continue with our mastery of the markets as always. Agenda for today, we're going to be looking at the market. From there, we'll move into trade review. Look at the trades that we have, which we do have a bunch of trades that need to be managed. So we'll talk about that, and then we'll look at new opportunities. That's the plan. I believe all is ready for us to get started, so let's do that. Cool. So here we go. Let's move into top. So here's top, and let's begin with the analysis of the VIX. Let me type it properly. VIX. Here we go. So we are looking at the VIX. Let me move to a 55-minute time frame of the VIX. Here we go, and we can see the VIX is currently trading at 2472. This is definitely, if we look at the top of the screen and the bottom of the screen, obviously it's quite low. Okay, so the VIX is quite low given the amazing drop that it has experienced continuously for multiple days since sometime in October. Okay, in recent times, yesterday and today as well, there has been a great increase in the VIX. This has a lot to do with the markets moving down. Today the market was gapping down, even though the VIX is up by just a little bit, not that much. So again, all of those are market interpretation and also price movement going from red UFOs to green UFOs and vice versa. You can see here the beautiful reaction to the UFO on the way down. Okay, so in any case, with the VIX, you could certainly trade the VIX. You could trade VIX futures intraday if you'd like. But with the VIX, when we do our options trade, we don't need to be that precise. It's more about gauging, is it high, is it low, is it in between, something like that. That's good enough for us to position ourselves with the right type of strategies with positive vega, such as buying premium, doing debit spreads, for example, strategies with negative vega, for example, doing iron condors or doing credit spreads. So positioning ourselves with the right vega exposure, given where the VIX is at, because if the VIX is going up, overall, you would expect the majority of the stocks to have an impact and have their implied volatility to tend to rise. And if the VIX continues going down, you would expect the opposite to be true. So it's a good thing knowing that individual names, individual stocks have levels of volatility which could be totally different compared to what the VIX is doing right now. We may find stocks with very high implied volatility. Well, the fact is that even if those stocks got high implied volatility, if the VIX falls, those volatilities will tend to fall. If the VIX rallies, those volatility will tend to rally. So we like to understand more or less where is the VIX, so we focus on a specific type of strategy. So question for you guys, as you are listening to me, as you are thinking about what I just said, please type it on the chat box. Given the fact that the VIX is more on the low side versus being more on the high side, what type of strategies should we be employing to take advantage of that fact. Okay, so I'll be checking the chat box in just a little bit. I'll give you the answer too, of course, in case your answers are not accurate. But I'm counting on you guys to give me the right answer. So go for it, and I will check in a moment. Okay, what type of strategies should we employ? In parallel, I'm going to be looking at SPY, and we're going to do some market analysis. Today we are meeting at the perfect time, to be honest. The S&P is trading exactly where the average is, right there. Okay, so it's beautiful. So what kind of market environment do we have? Okay, so the S&P is in an up climate. It's a thick dot, so the climate is confirmed. Okay, it's a confirmed climate to the upside. And statistics suggest this is number 5. A normal thing to happen is 5. So we are more or less coming to what potentially could be the end of the climate. That is a little bit of a concern, given the fact that the max distance current value is 167, where 2 standard deviations of max distance with 0.83. So in other words, we went like, let's say twice as far. So it's like 4 standard deviations when it comes to the price movement to the upside. And this, by the way, that was that day. Okay, that was the guilty day. That was the day 1 week ago, exactly 1 week ago, when the S&P went up 5.5%, when the Nasdaq went up 7.5% in one day. Unbelievable. A few years back, it would take a year for the Nasdaq, for the S&P to move 7.5%. This happened in one day. So the level of volatility was tremendous. Here we can see it in a statistical format as 4 standard deviations. Okay, so unbelievable. And while normally that would be a concern if I was to go long somewhere up here, the fact that the market has retraced so much, to be honest, it's not that much of a concern anymore for me, because I'm looking at it more like a very, very strong, violent move to the upside, which is a very, very strong confirmation of the intention of the market of going higher with such an impulse. Okay, we've been talking about this since September, where buyers came in the market with the blue line above the gray line all the time. Okay, and of course, if you were in a down climate situation, the market was going down. But the moment you had the opportunity to go blue, and the moment the climate was confirmed, the speed of pushes to the upside has been very, very powerful, confirming what the blue line is telling us. I mean, it's not like we need confirmation, because computers process data better than humans. But if you wish, visually speaking, we can see what that blue line is doing. So you got buyers in the market. You don't know what price, but you got buyers in the market. So the moment the climate confirms, we are seeing those very, very powerful pushes. And what happens with those pushes is that down climates will tend to last very little. Okay, and then you have much more blue. So in other words, given the fact that the price is trading at an average, given the fact that we got buyers in the market, given the fact that we are 5 out of 5, which is still giving me permission to trade, I'm gonna be very, very, very happy to be looking at opportunities to be a buyer. Okay, to be a buyer. And if the market goes against me, of course, it's gonna be a bad news. But my expectation would be a little bit of red and then back to blue. And given the fact that we got buyers in the market, strong pushes to the upside are to be expected. That would be my anticipation of what the markets may have to offer, given the statistical analysis I just performed. Okay, so in that sense, okay, I'm going back to my prior question about the VIX, right? So if you think about the VIX being low, and you think about the market giving us perfect setup for us to get directional long, well, the type of strategy I would like to employ is going to be debit spread, vertical spreads, more specifically bull call spreads. That would be the type of strategy I would rather use most of the times. So I'm going to be looking at cheap options, stocks with cheap options, and build that type of trades. If I don't find, very good, Jeff, very good, well said, debit spreads. Ahmed, how are you, my friend? Good to see you. So if we were not to find this type of opportunities easily, not a problem. We can always neutralize Vega exposures, doing ratio spreads, doing directional butterflies. So we'll work on all of those tweaks if needed. But in a perfect world, this is the type of opportunity I would be looking for. Okay, so that's my little market intro, market analysis, so we understand what to expect. Okay. So this is kind of like market analysis / portfolio management, right? Because knowing what the market is likely going to do not only you can find one trade, but actually you could think of your portfolio overall, and maybe you already have too many longs, so you don't take more, even though the market's likely going to go long. If you have many more longs, you don't, etc., etc. Okay, so today I'm not going to be doing non-directional trading, okay, like we've been doing for a long time in prior sessions. So now, before we get into finding new trades, we need to review the trades that we have running. So I'm going to start with Autodesk. And as I said at the beginning of the session, I have been absent. Last week, I was not well. Sorry about that, my friends. But basically, that has a consequence, which is the fact that we have trades in the account, for example, Autodesk, where we have been assigned and we have shares of stock. In this particular case, I am short 100 shares of stock together with my two options. And remember, we talked about this many times in prior sessions, how it's not an issue at all. There is a margin impact, there is a buying power impact when it comes to being assigned. But from a risk point of view, given the fact that Autodesk was a double calendar trade, and we had a long call and a long put together, so that is not a problem at all. Okay, so what can we do? Well, first of all, we need to get rid of those shares and get back into selling options, right? But let's revisit all this trade, because it's been a couple of weeks that I didn't visit this trade with you, and many things could have changed, including the earnings date. In the end, doing those double calendars in front of earnings have a lot to do with collecting the rise of implied volatility, which is not going to happen if the earnings date has changed, which in this case, it seems to be the same, because we were looking at this dotted line as the expiration date, and the earning date is happening right before. Notice that sometimes the earning date will be pushed forward, and then that really hurts the trade. So we need to keep all of this into consideration, isn't it? Cool. So where are we at? Well, we're in a position where November 25 is the expiration. If we look at Autodesk, November 25 is what we got. If we look at the next expiration, okay, I mean, next Friday, which is tomorrow, is November 18, but the next one is November 25. So really, when working on this trade, since I didn't do the roll last week, since we didn't meet last week, so when working on this trade, I don't need to roll it to become another double calendar. I need to roll it to become a double diagonal, because if I was to use the same expiration date of November 25 and I was to sell the 215 call against the call I own, I would be closing the 215 call and I would end up with nothing. So I need to make it a double calendar, which means I'm going to be selling the 220, which is above the 215, and I'm going to be selling the 185, which is below the 190. And now this becomes a double diagonal instead of a double calendar. Okay, now that's the idea in the back of my mind, but nothing is going to be done unless I first graph it and I understand what is it that I've got in my hands. Okay, and when I graph it, I'm going to have a little bit of a problem here because the two legs, November 11 legs, okay, are gone because that expired last week when we didn't meet. And when I do my simulation, I only have two legs instead of four. Okay, so we need to work on this a bit more precisely to find out better what is it that's going to happen if we roll the trade. If we don't roll the trade, maybe we conclude, let's close the trade, and that's it. Okay, so we need to understand what is it that we got on our hands. In order to be able to do that, I am going to pretend that I am doing the normal thing. So I'm going to add two options legs, which are going to be selling using November 25. And I'm going to look at what if I sell the 220 call and what if I sell the 185 put, with the midpoints I mentioned before. So what if I was to do that, right? So this is the first thing I wanted to do. Okay? So if I was to do that, this would be the risk profile. Of course, this is not adequate because we are missing on all the premium collected here. So there is $550 of premium collected here and $510 of premium collected here. So altogether is over $1,000 of premium collected. So this graph, it's not accurate. Okay, so I'm gonna have to add Okay, I have here 675 for the 220, 88 for the 185. So I'm gonna have to add to the 675, okay, 680 now. So to the 675, I'm gonna have to add 550. Okay, so let me bring a calculator to the screen. Okay, so 550, that's what I got from this option, which is the 215 call that expired on the prior rolls. And if I do the 220 call now, it's paying me 680. So 550 plus 680, that is a total amount of premium of 12.3. Okay, which sounds beautiful. Okay, now it's not as beautiful as it looks like. You will see why in a moment. If I do the same for the put, right? So the put is currently paying 88 cents. Okay, 88 cents. And the puts help us to collect already 5.10. So 5.10 and 88, that is 598. Okay, so if I was to do that, the risk graph looks like that and is amazing because you will be making $655 as we speak, and worst case would be to make $378. That would be the worst case, but that is not accurate. Why is that not accurate? Well, because this is not taking into the consideration the fact that we have been assigned shares of stock. So let's go back to TOS here and notice how we got 100 shares of stock at 215. Okay, we got 100 shares of stock short at 215, right? And if I was to close my shares now, that stock is currently trading at 215.66. So 215 minus 215.66, that is 66 cents of pain. So in other words, the 12.30 I got here are less. Okay, the 12.30 should be 11.64. Okay, and if I do that, now I end up with this graph, which is the accurate graph, where this trade is currently producing $589 of profit per contract. Okay, with a worst case scenario of making 312, which a best case scenario which is to make 812. That's the trade that we have in our hands. So in other words, doing the conversion from a double calendar, which was a trade with where the stock was assigned, doing that conversion to a double diagonal by selling a new call, a new put, one strike above the call, selling the new put, one strike below the put, and closing the stock would put us in this particular position. So of course, when I do the execution, my prices may be a bit different. So I may need to come back here and rectify to have the exact values, but this is more or less what I'm expecting to get. Okay, so I'm going to do the execution. In the meantime, in the chat box, if there is any question, this would be the perfect time for you to ask. And if there is no question, so then that's it. So I'm just going to do the execution. Okay, so first thing I'm going to do is I'm going to close the stock. Okay, so I can do it market. So I'm going to get rid of the stock. Okay, so stock is gone. This was going to produce a little bit of pain. Okay, a little bit of pain. But now, in exchange for this pain, I can go ahead and load Autodesk with the expiration date 25. And now above the 215, okay, I can sell the 220. And below the 190, I can sell the 185. And if I do that, I'm going to collect $782 in premium. So I'm just going to do it. Okay, let's see if I get fill. 782, 785. So let me move this quickly. You know from prior sessions, if you're new to the sessions, don't be scared. If you are a veteran, you know in the live sessions, I always get super aggressive at moving the prices of my options trades so I get filled quickly, so I don't waste time. So that way I can continue with the execution, the practice, and the illustration demonstration for you guys. In real trading, you want to take it easy here to get the best prices as possible. You want to be patient. You are trying to get 775. The midpoint is 775. Just wait a bit because you may get filled, right? So no need to rush it. But in my case, I do rush it, okay, because I want to get filled so I can continue. So please don't do that at home. That's it. I got filled at 770. Great. Thank you. Fantastic. So let's get the prices, okay? And we can do the math now and document this properly. So for the stock, I got filled at 216.09. Let's use some calculator here. So I got 215 minus 216.09. That means I lost $1.09. But from the call side, I got 685. So altogether is 576. 576 plus what I already had before, which was 550. So 576 plus 550, that should be 1126 instead of 1126 instead of 1164. And on the put side, so I had 510. So 510 is what I had, and now I just collected another 85 cents right there. So plus 85, that is 595, and that is the value I will need to input in my simulation. I said 595, yes. So 595 instead of 598. Okay, here we go. So this is the trade, a trade where worst case you're gonna make 271, best case you're gonna make 771. Okay, so nice trade, and now we just let it be, and then next week earnings will be reported on Autodesk. Ideally, that stock jumps heavily, and on expiration we end up either above 220 or below 190, 185. And the trade is going to be very, very profitable. Okay, very, very, very nicely profitable. So the trade is now adjusted. I'm going to copy the position to the clipboard so I can paste it here on my positions panel. Okay, and it's all now clear. So everybody, you guys let me know if there is any question, because I am now ready to move to the next trade, okay, which is the one we had on Coca-Cola. Or you know what, maybe we'll do Morgan Stanley first because it's also a double calendar. So let's go ahead and talk about this trade, okay? So Morgan Stanley is also a double calendar, and same story. If I right click and risk graph it, I'm gonna get with only 2 units, where the reality is that we are in a much better position than that, because we had 4 units from the beginning. It's just that we didn't meet last week. Okay, thank you, Mark. Thank you so much. Yeah, this is the game that we play with those double calendars. Some of them are just so-so. Many of them are just so-so, but sometimes you get this, a very powerful one. Okay, and this is kind of like the game that we play. Manage the risk, reduce the risk, play with the patience, and from time to time hit a home run, if you wish. Okay, even though I'm not into baseball. Anyway, so Morgan Stanley. Okay, so what do we have here? Again, November 11 already expired. We are using here January 20, so we have many dates in front of us. So I mean, we're just gonna do it. Okay, we're just gonna sell the 90 call. So let me add 2 more legs. We're gonna sell, and we're gonna sell the 90 call that expires in November 25. November 25, mid price, and we're gonna sell the 80 put that expires in November 25. So I click OK, we'll be able to see the prices here. 65 and 8 cents. So 8 cents is something I'm not happy about. Okay, you guys know I would normally place those limit orders with 15 cents, isn't it? So that's what I'm gonna do. Okay, I'm just gonna go for a 15-cent limit order. So let's begin with Morgan Stanley MS November 25, 80 put, 15 cents. Okay, we'll make it good till cancel. If we don't get filled today, the order will be waiting until that expiration date. That expiration cycle reaches the expiration date. Okay, so we got our 80 put, 15 cents, sell, good till cancel using November 25. Okay, so we have that here. Okay, and now I am going to take care of the call side, which is 90, where the 90 pays between 59 and 62. So we're gonna try to get 59, 60 the midpoint. Let's go for 59. See if we get fill. Okay, we got fill. We got filled at 59. Very good, perfect. Okay, so what do we have? Okay, so we have this. So we've got 59 cents on the call side, but this is to be added to what we already had on the call side, which is 14 cents. Okay, so calculator, 14 cents plus 59, that is 73. So we're dealing with 73, and then for the put, we had 53. Okay, so let's assume I'm gonna get 15, and if not, I will delete that 15 next week. So that's 68. Okay, so 0.68. Okay, so what do we have? So this is the trade. Okay, so we are currently making $33 if we're in this trade. We're in the green space. Okay, and again, if volatility rises, so we're gonna make so much more, which is the goal. And you saw it work very well on Autodesk. That's the effect of the volatility rising. That's why this trade has worked pretty powerfully. Okay, so that's what we're trying to do here with Morgan Stanley. Okay, so now the one thing I have not done, which is my mistake, is to close the stock. Okay, so we need to close the stock. Here we go. And now I'm going to be able to calculate what was the impact of that. Because in this case, we got the stock put to us at 90, right? And we just closed the stock at 88.11. So actually, we just made a profit on the stock. So 90 minus 88.11, that is a $1.89 of profit. So if I take this to our 73 cents on the call side, so 73 cents plus 189, that's 262. So if I edit and I make this to be 262, so we are here. Okay, we are currently making $220 on this trade. These trades still have risk. Okay, we could lose 290. Okay, we could lose 290. But again, with time passing and so many more rolls, I would say it's almost a sure thing at this point that this trade, as long as we keep rolling every week, it's almost a sure thing that this trade will not lose unless the premium shrinks like crazy. This trade should behave very well, and as the earnings date approach, which is going to be in January, we need to be patient for that. So we may have this extra increase of profitability. Okay, so looking good. I'm just gonna right click, copy to the clipboard, paste it next to Morgan Stanley, and we just need to keep playing the game. Okay, so let me take a look at the account and make sure all is good. So stock is good, and the only thing I'm waiting for, this is my red order here, is to get that 80 put, which that would happen if the stock keeps falling a bit more. So then we should be okay. Good. So doing well so far with those particular trades. And then the last one for us to review is Coca-Cola. Okay, Coca-Cola, KO, which Coca-Cola, we can see it very well here on the right. So we took the trade here. It went against us pretty aggressively. And the last time that we met, as it was coming back up, I believe, Mark, you asked me where to set the target, and we added that here, isn't it? So notice how those speed bumps are actually quite powerful to identify relevant turning points. And sure enough, here we had a very significant turning point. Okay, so in a way, if you were conservative on taking profits, we should be out of the trade, and this trade would have been profitable. Now, given the fact that we are trading at the average, given the fact that the S&P, is in the position we discussed before, so certainly I'm not going to close the trade now. I'm just going to wait for this to continue. And what I'm going to do, though, is I'm just going to move these to this location, and this potentially would show a target a bit higher. Okay, so I'm waiting for this target now around 62 something. You didn't get 62 and a half. Okay, Murphy's law. That's called Murphy's law, Mark. Okay, because so 62 and a half, 62.38 to be precise. That would be our new target now. Okay, for this trade. So 62 and a half makes a lot of sense too. Okay, so again, a bit of Murphy's law there. Okay. So now what do we do? Let's try to examine this trade a bit better and try to understand what is it that we have in our hands. So if you recall, this trade is made of selling two puts, okay, and in exchange for selling those two puts, we bought a put as well. So then we ended up buying a call, creating that positive delta effect. This trade is benefiting now from a positive 16 delta. That delta was better when the stock was going higher, but again, unfortunately, it went down. Okay, so what can we do here? Is there anything that we can do? Isn't there anything that we should do? So again, going back to the charts, I mean, if you look at the distance where the stock is compared to the horizontal line, which is where we started, we are basically where we were. Okay, we are basically where we were. That's why when you look at the P&L of the trade, it's showing us $2. Okay, so we are basically breaking even. Okay. Of course, we have 3 contracts in place, so we suffer slippage, etc. So, we are slightly above, and we are doing a little bit better. Okay, so this is a little bit of time decay that worked in our favor. This trade is making 17 cents a day on time decay. It's very tiny, so that's why basically the number is flat. Okay, so all good, all normal. We just need that stock to move. So if you didn't take profits before, we just need the stock to move, and really there is nothing else to be done from a management point of view that could make this trade to be better. Remember as well the mindset behind this trade, which is that if Coca-Cola falls, we are happy stock owners of Coca-Cola at that lower price. Okay, so nothing to be done, just to wait for another push to happen, and then we'll take profit higher. Cool. Okay, so let's look for trades then. Okay, I'll take a sip of water, and we go for it. Okay, so we are looking for directional opportunities. Okay, I'm going to start with all stocks. We want directional opportunities, and of course, we want to rely on the strength of the group. Okay, so I'm going to start with, do we find any long-term strength? Okay, I'm going to start with that. I'm going to import my penny increment options list. We're going to make sure that neutrality is on check. We don't want neutrality. We want to be directional. Earnings, anything report earnings in less than 30 days will be ignored. And then, of course, in a perfect world, and you heard me a million times say perfect world, that means that we have very few return opportunities or none. So you will want the weekly climate to be early, the daily climate to be sensible and near the 9 EMA. So do we have anything like that? Scan. Wow, 2. Okay, so Pfizer is 1 of 1, and Morgan Stanley. Okay, so now what if I add very low volatility? Okay, so CIV mean less than 20. Pfizer does meet this condition. Okay, so wow, again, I was not expecting to have any return. because this is very demanding, as you can see. Okay, but we have one. So let's take a look. Okay, let's take a look. So what do we have? Pfizer coming to the EMA. Pfizer in an up climate, which is confirmed 5 out of 6. Okay, blue line above the gray. So all of this is giving us permission to plan on a trade. Okay, let's go back to the 55-minute time frame. We got green UFOs below. Okay, actually that's a bonus one here. It's creating a long-term Elliott wave turning point in the 55-minute time frame with a potential target of the upper orange zone. That's okay, but the one thing I'm not very comfortable about is the fact that we have here the 49%, the 49% performance stats. For directional trading, we like to have that 50%. Okay, so what if I look at other time frames like 89? Does it get better? %53%. It gets better. We also have an Elliott wave turning point, but we have no green UFO at this price point. Okay, the next UFO will be located very low, so that makes me uncomfortable. Okay, that makes me uncomfortable. What if we look at the 144 in time frame? So we have 52%, and there we have UFOs a bit lower. Okay, so we're talking about 46, which is down here. Okay, what if I look at the 233? So loading the chart here for the 243. We got 62%. That's very nice, but no UFO. Okay, so what if I go down the time frames and I look at the 34? We got 53%, and the UFOs are quite close at 43 something. So definitely we got multiple time frames with probabilities 50 or above, with UFOs that are nearby. So I do feel confident. I do feel comfortable planning on a trade of this sort, knowing that this sector is also in our favor, knowing that the climate is beginning on the weekly, that on the daily we have a sensible climate. We are near the EMA. We even have the bonus Elliott wave turning points. Okay, so it doesn't mean the trade is going to profit for sure. There is nothing sure in trading in life, but certainly it does seem that the setup does provide odds in our favor. So if we take this trade, the next question is, where are we going to set our target? And if I look at the daily time frame and I was to project our speed bumps from here, from the top, okay, so this would show as a potential location for targets to be here. Out of curiosity, if I look at the prior speed bump, yeah, that's where the turn took place. Okay, so that one will not be a valid target anymore, but that one would. Okay. So let's plan for this. Okay, so our target will be 50.70 up there. Okay, so 50.70 up there, and if we right click and we add and we send to the strategy builder, did I send it to strategy builder? Oh no, I think okay. Strategy builder. I think I sent it to the other tool. Okay, here we go. So we are talking about December expression. Okay, we're talking about December expression. Earnings are not going to happen until here, which is February. Okay, so we got plenty of time to get to this target with no earnings risk. That's nice. Okay, plenty of time. And therefore, I need to sort this trade based on performance and see what's best. The bull call spread, as expected, would be the one performing the best. using the 50 and the 55 strike, using January expiration, which is also happening. January expiration is also happening before earnings. So this is indeed a valid setup. I would like to look a bit more into that choice. This is a choice where we are risking $105 per contract if we do this trade. So it's a nice one, including for practice purposes, because worst case you're going to lose 105. So I guess that we can assume that risk is in it. There are trades with higher risk, 600, 700. That one is a trade with 105. So yeah, this trade makes sense, my friends. I'm not going to make it more complicated than that. I'm just going to load a risk graph so we can see it. This is the trade. Okay. Buying the 50 call on January, selling the 55 call in January as well on Pfizer. And I'm just going to go ahead and put this trade together. So let me go ahead here. Pfizer. If we are looking at January 20, we are buying the 50 and selling the 55, right? That's for a debit of 104, buying the 50, selling the 55. Let me double check one more time. Buying the 50, selling the 55. Yes, January 20. Yes, correct. Okay, so let's place the order. And while I'm waiting to get filled, I will bring these back to the screen so you guys can take a screenshot if you were to need to do that. Okay, here we go. Here's a screenshot. We're waiting to get filled. 105. Current price is 104.5. So let me push it. Let's say I want to pay 110. I got filled at 106. Okay, filled at 106. Okay, so I got it. So let me customize the prices. I'm going to edit the spread and select field price. And for the 50, we got filled at 133. And for the 55, we got filled at 27 cents. So I'm going to click OK. This is a trade where best case we're going to make 394, worst case we're going to make 106. And I'm just going to copy this, and I'm just going to move this to the positions panel. And here's another one. Okay. Now in this case, at this moment in time on my account, I got two long trades, one with Coca-Cola, one with Pfizer. Okay, and I got two non-directional trades. Okay, one of them doesn't count because you cannot lose anymore, which is Autodesk, and the other one has very little risk but still some risk. Okay, so I got two directional trades, two non-directional trades. That's what I have in my account. Okay, so I'm going to comment on that in just a moment. How is it going so far with the Pfizer trade? Any question? If all is good, please type all good, so I know all is good. So that way I can continue. Thank you, Jeff. Great. So I'll get rid of the risk graph. Now I want to go back to TOS. Okay, and again, I want to talk a bit more about the Greeks. Okay, and notice from a delta point of view, the Pfizer trade I just got in, the debit cannot be 57 cents. It has to be 106. Ahmed, you may be using different strikes. Make sure you are using January 20 and you're using 50 and 55 call. Please double check, reconfirm that. I got 2 units. I have no idea how I ended up with 2 units here, but I got 2 units. Okay, so yeah, forget about it. It's one of each. Okay, so one call buy, one call sell. I know what I did wrong. Okay, yeah, my bad. Yeah, when I placed the order, I made a mistake. Anyway, it doesn't matter. So one of each, okay, and just make sure you're using the 50 call and the 55 call using January 20, 2023 expiration. Please double check that, and Ahmed, please get back to me and confirm on the chat box that now you are getting that 106 or 105 debit for this trade. Okay, now again, Pfizer, it's a directional trade that not only is directional, it's very directional. That is 50 delta. Coca-Cola is directional but little, 16 delta. And then Autodesk and Morgan Stanley are non-directional, so the delta is 5 or -8, which is very little. Okay, so again, if you have a portfolio like that, your total delta is 63. So again, while the S&P is suggesting let's go find long trades, well, the reality is that if you keep adding on longs, you got it. Wonderful. Thank you for confirming, Ahmed. So if you keep, got you. Perfect. Great teamwork. And this is what I love about the sessions, guys. This interaction, it's what we need to make sure that no mistakes and things like that. So thanks for that. So let's say I add another long, right? Because based on my analysis before, I say, well, the S&P today is suggesting to go long. So let's say you add another long and then another long. Next thing you know, let's say now the S&P does not behave as expected based on stats, and next thing you know, the S&P drops. What would happen to your portfolio? Well, huge problem, isn't it? So what can we do? Well, maybe we can look for some hedging opportunity. Okay, maybe we can look for some hedging opportunity. And for the hedging opportunities, maybe you just want to identify them, and it's no need to trigger those trades unless the market starts falling and give you a bit more of an evidence that it's crashing. Okay, so how can we do all of this? Let's do it. First, you go 106, 104, 104. Perfect. So first, let's find a shorting opportunity. So how are we going to do that? The complete opposite as before. So I'm going to be looking at all symbols. Instead of looking at strong up, we're going to look at strong down. When it comes to auto climate, we're going to look at, because it's hedging, it's going to be short term, so I don't care about the weekly climate. I'm going to be looking for confirm down, ideally near the EMA. Do we have anything like that? No. What about further away from the EMA? Yes. Okay, so we have a few where the long term is down, okay, and the climate is down as well, sensible. So let's take a look at the setups. Okay, let's take a look at the setups. So STX confirm, but the blue line is above the gray, so there are buyers somewhere. Target, we're very far from the EMA, a huge gap. Again, we may fill in the gap on the way up, so not interested. Twilio, we got buyers on board. Okay, so not happy with those setups for hedging purposes. If I had to choose one, probably I'd go for STX because it's the nearest to the average. It started the down climate, so if something is about to work, that's the one that will work the best to go down. But all those setups are not making me too happy. And so I would like to find a setup which is a bit more precise. So what if I look at strong down in the midterm? Because really what I'm looking to do is to hedge with this trade. I'm not planning to be in this trade for too long, only to hedge. So target shows up again, okay, which is not helping because we had it before. And what if I look at markets that rotated, sectors, groups that rotated 10 days or less before? So now I have a couple more. UNH. Okay, UNH, to be honest, this is the one I would like the most based on this because we're in a down climate. Yes, the blue line is above the gray, but just by a little bit, tiny bit. And we are very close to the moving average, which may act as a nice support. And from there, prices react and keep going lower. So UNH is looking okay for that purpose. Okay, so now, do we have 50% or more? Yes, but no UFO. So that's not making me happy. What if we go to the 50? What if we go to the 89 in the time frame? No. What if we go to the 144? I don't think so either. No. What if we go to the 34? No. So that stock is likely going to rally way past the average. Okay, so I would not want to use it for hedging because there is no UFO helping that stock to move down. Okay, and it may go down because the S&P then, instead of going up, it goes down, and my market analysis was off. That could happen, and it could create that cascade effect, and UNH is going down too. But the fact that UNH does not have UFOs, it's a concern. So what about AMED? Not sure. Options are going to be liquid here. And also, the blue is above the gray significantly. So I'm not happy with the setups I'm finding for hedging purposes here. Let me try to look a bit more. So, okay. So based on what we just said here, I don't have any sector which is giving me what I want. Okay. So if I go back to here. Here. Okay, my list is very short, and one of the reasons why the list is short probably is because the auto climate, I am demanding the auto climate to have a specific condition. So what if I do not demand? So now I have a few more. So we have Disney. Long duration 11 out of 5, so not too happy about that. Seagate Technology, well, that's the one we said before. Target we said before. Tesla. So Tesla, the buyers and the sellers are similar. The climate is 11 out of 5. That's a long duration. And Twilio, we talked about it already. Yeah, it's a tough one. It's a tough one. What if we do strong down? Yeah, Tesla. Yeah. So tough one. So then, because it's tough one, okay, and what it is what it is. So I'm going to have to look for other forces that potentially help that stock to go down. I want to use it for hedging purposes. And by the way, when hedging is also a very smart approach to maybe use a little bit of a smaller size. You don't want to be 100% hedged, because if you were to be 100% hedged, and it doesn't matter if the market goes up or down, you never make money because you're too hedged, right? So how can I look for opportunities where I have a directional bias to the downside? I'm going to use the volume map, and I'm going to select the put to be greater than 1.5%. Okay, so this is creating new opportunities, which, I unchecked the group, okay? But it's creating new opportunities where, at least from an options volume point of view, we can sense this is coming. And again, the blue line is above the gray by a lot. With CVS, and what about COF? Same story. Interesting. Okay, interesting. Really, it's like it's gonna be a very big surprise if the markets end up going down, because everything is pointing up. Like even stocks with down climate, with down volume, still overall as an average, as a 3-day average, show implied volatility of the calls above implied volatility of the puts, which means that if the market takes a dip, buyers are going to be found and it's going to bounce back up. Okay, this is what we have seen as price action recently in the past few months, and this is still the market environment that we have. So again, the bad news is that I'm not finding opportunity. I'm not finding valid opportunities for me to hedge my portfolio. The good news is that the risk of my portfolio is limited, because with all those setups that we find that show buyers are in the market, well, if the market was to take a dip, typically it would bounce back up quickly. So not too concerned, even though I would certainly like to find an opportunity. Okay, so my last attempt, I need to take a sip of water, guys. Sorry for that. Okay, sorry about that. So my last attempt is going to be to rely on the gray line to be above the blue line, but today. So I'm going to be looking at a top negative CIV spread. That's what I'm looking for. So these, for example, if I look at DVN, you may see that actually we have the gray above the blue, so that's good. But we may have cases where, like for example, UNH, the blue is above the gray. Okay, but if I was to uncheck the smoothing, which is the 3-day average, okay, you would see how the gray is above the blue. just by a little bit. In this case, just by a few decimal places, but it's above the blue. So that's what I'm filtering now for. Okay, instead of looking at this as an average, I'm looking at it as today. Okay, that's what I'm looking for. And with that, so we end up with multiple choices. And I'm going to look at Altria Group. I'm going to look at DVN. So DVN looking good, just a bit far from the EMA, CMA. I would say this is the one I like the most because it's starting its climate, 1 out of 4. Sellers are on board since a while ago, and sellers are proving to be there. Since the sellers were identified, the market has been going down. So CMA could be a valid candidate. Now, I was going to say that we only have monthly expiration options on CMA. So while the technicals are good, from an options point of view, we're going to have little choices. So FIS, 11 out of 5, and then UNH. UNH, we said we have no UFOs. So I'm not happy about that. So let's go back to MO. This will be my next pick. Okay, 6 out of 5 is a little bit extended, but 102 out of 144 is not so extended. So out of the various candidates I have, notice I'm looking, to be honest, this reminds me of the time where I used to do ballroom competitions, if I can share with you that story. So, when I was an amateur dancer and, I would compare myself, in my competitions with professionals, with a world champion, to be honest, I was quite bad. But there were times where I was winning competitions. And why is that? Well, because, I was being compared with other people from my same group, where probably were all amateur dancers, not that good. So you could actually win being the less bad, of the weak group, if you wish. So this is kind of like what I've been doing today with my selection. I'm looking for an opportunity to hedge my portfolio because I got plenty of positive delta. I'm not finding any setup which is a clear short setup, even though the S&P is pointing up. I'm not finding any setup which is a clear short. So I'm trying to find any setup that is acceptable, knowing that it's not going to be the best setup in the world. Okay, I'm looking at the best of the worst. Okay, if I can phrase it like that. Not sure this is proper English. You got me. Okay. Anyway, so MO. Okay, so we're gonna go for this. Okay, we got 57% red UFO right there, and all of this is making sense. So if we were to get into this trade, okay, we would expect that stock to fall down all the way to here. Okay, so if this is gonna be our target, I'm gonna be too far. Here we go. So send to strategy builder. Okay, we're gonna sort this, and a bear put spread is being recommended here. Interesting. Let me take a look at implied volatility. Actually the implied volatility for the stock is quite high. So while the S&P has low volatility, that stock has quite high volatility. So I certainly agree that this bear put spread is probably the way to do it. Okay. Now 40 to 42 and a half, that is producing a delta of 20 something. What if we do it out of the money? So if we do it out of the money, the bear put spread 40, 42 and a half is kind of like the same one. We have a few more before this kind of same one. What if I go way out of the money? Yeah. So given the fact that that stock is low price, given the fact that strike price increments are 2.5 at the time, given the fact that my target is very close, because my target is 42.70, the current price is 43 something, so it's $1 drop, and strike price increments are $2.5 at a time. Doesn't matter if I select at the money or out of the money, the results are going to be the same. So yeah, so that's the one. Okay, my friends, this is going to be the one. The bear put spread using the 42.5 and the 40. This is the trade that we're going to execute, and we'll call it a day. Okay, this is a trade where we are risking 48 in order to make 201, if right. Okay, and I'm going to execute that December 16 in this case. So this is Altria Group, ticker symbol MO. December expiration, December 16. And we are going with the puts. And we are going to do buy 42.5, sell 40. Okay, this is a 52 debit trade. This is nice because if we lose, we're going to lose only 52. And if the other stocks profit, we're going to profit way more than the 52 we lose. Is that making sense? Because it's a hedge. So looking good. Looking actually very nice. So I'm just going to place the order. See if I get filled. I just got filled at 49. Okay. And let's document the trade. Fill price, fill price. So the 40 put we sold, we got 23 and 72. Okay. Right click, copy, and you paste that to the positions panel. So my friends, we just reached the ending part of the session. So we are done for today. Before we say final bye, I'd love to hear, even if it's just one word from you, could be okay on the chat box. And if it's not okay or you have any pending question, I'm certainly happy to stay a bit longer and I can give you the answers that you need. But basically, the session is over, and I'd certainly like to get your feedback. So please type it in on the chat box if you don't mind. Also, I wanted to share with you a couple of things. I said it last time, to be honest. I believe it was 2 weeks ago when I said that we are going to make changes on the way on how we schedule sessions into December and beyond. We're going to be a bit more dynamic. Instead of meeting like once a week or something like that, we're going to produce trades during the week and throw them out there so you guys have more materials to be able to practice. Okay, so we'll document those trades. We'll have videos. Those videos will be streaming live, but it's going to be whenever the trades are available in the market. So I will recommend you all to set up your phones with your YouTube app by following our YouTube channel and turn on notifications so when we are live, you get a pop-up message. Of course, you can then go back and watch it recorded. And for sure, we'll also run our 1 hour session where you can join and ask questions and everything else. Okay, so we'll be doing that. But we're going to be changing a little bit of the format to help being a bit more dynamic, okay, which seems to be needed in the community. And in parallel, and this I cannot share more of the next thing I'm going to say, but I want to make sure all of you make sure that you receive our emails in your inbox, not a spam folder, because starting on the 21st, we have a very, very important announcement, very exciting announcement to be made, which I cannot share yet. But it's a new product that we're launching, and I'm super, 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 super excited to share. It's not a new app or anything like that. It's just a new way to do things, and that's how far I can read. And I believe you will enjoy it very much. It's going to be lots of fun, and it's going to help a lot of people. Okay. Many people out there. So make sure you have your email set up to receive our emails, not in the spam folder. And that way, when we start communicating, we're going to be sending emails starting next week on the 21st. Okay, so make sure you are in tune with us, because again, I have a big smile on my face because I'm super excited. Something totally new, including for myself. Okay, so exciting times. You guys, see you soon. Thank you for being part of what we do as always. And keep up the good work. And I'll see you around. And you guys take care. Bye-bye.